Smart 24, driving business.
Very good morning, ladies and gentlemen, and a warm welcome to the program. This is Smart 24 TV. We drive your business. My name is Anthony Sebali, together with my colleague
Victor Chileru.
And we are here to give you a little taste into what is happening in the financial markets. Well, the show catches you can catch the show every Monday to Friday, exactly 10 a.m. and we're always here to give you updates on the different trends in financial markets. Financial markets investments are some of the most valuable in the entire world, but also some of the least known in Uganda. So we are here at Smart 24 TV to give you a chance and to give you, of course, a platform where you can be able to learn more about financial markets and get to know what is happening within the markets itself. You can, of course, join into the show on YouTube and give us a comment in the comment section at Smart 24 TV Live. You can also give us feedback through our Twitter, that is at Smart 24 TV Now. Now, today, ahead of the show, we have quite a number of interesting stories, one of them being the fact that the delay of the transition from CIPLA to African Capital Works as majority shareholder costs CIPLA at least 20 billion Ugandan shillings. We're going to be seeing details of that story, but we do also have quite a number of market performance analysis coming in from the Capital Markets Authority and the different segments of the financial markets, including the secondary markets, activity for treasury bonds and bills, that is of course the fixed income market, as well as any other segments that you might be interested in, especially the unit trust fund that have become so popular. If you want to know more about those, we're going to be going through a series of those the entire week, so you definitely want to stick around and get to know exactly the details that are contained therein. Well, Victor, let's see what's happening at the Uganda Securities Exchange as for the closure of trading yesterday.
Well, as of November 24th, 2023, at the end of the last weekend of trading on the Uganda Securities Exchange, we were left with a total of 349,619 shares, corresponding to a market value of 14,120,605. So the current market capitalization as of today stands at 16.3 trillion Ugandan shillings, which we're actually seeing an increase of an extra point from the last week. And in aggregate, we're looking at 6 listed equities participating, and we ended with about 3 gainers and 4 losers. KCB Group led the gainers with 1.47% share price appreciation, and this was closing at about 514.39 per share. It was closely followed by Equity Bank with a share price appreciation of 0.39%, and Jubilee Holdings with 0.28% share price appreciation. So, Anthony, what do you think about today's gainers?
Well, KCB came in really strong at 1.47% appreciation in price. And I would commend this for the current forex movement within the Kenyan shillings and the Ugandan shillings mainly, and Equity Bank Limited as well following suit with a 0.39% appreciation in price. The markets in Kenya have been stable, and that of course contributes to the performance of the secondary market here in Uganda for these particular stocks, including Jubilee Holdings, Equity, and KCB Group. But I want to just still say, and this is kind of a disclaimer, there hasn't been any participation of any of these counters in the market, and this continues to worry me, and still there's nothing much that can be done because these are some of the most illiquid stocks that we have on the market. So even with the gains, we still have a lot more to demand for in terms of performance from these particular stocks.
Well, moving on to the losers side, we're looking at Uganda Clays that came out last with an end-of-day price depreciation of about 5.29%, and we're looking at a share price of about 12.90 Ugandan shillings per share. It was followed by Centum Investments with a share price depreciation of 3.38%, and Stanbic Bank with a share price depreciation of 0.78%. We're also looking at MTN MTN with a share price depreciation of 0.06%. So, Anthony, this is the first time we're actually seeing MTN and Stanbic on the losing side in almost a month. What do you think about that?
Talking about Stanbic, to me, I think it's more of the usual stock market that we see mainly, even on the international platforms. You don't have a stock up there all the time, and with this slight movement, they still can be made up for the volumes. At least when you look at the traded volumes, after Bank of Baroda, it was Stanbic coming in the second position in the number of volumes that were traded. So what I can say is that, given the fact that people are still more interested in buying and selling the stock, anytime from now the stock would still go up or down depending on the sentiments of investors. But for Stanbic Bank in particular, let's just giving you an overview of the performance. There has been at least a year-to-date performance of 52.4% appreciation. So you can imagine, despite the daily loss of 0.78%, we still have a backing of over 52% gain in the year to date since the year began. As of course, Stanbic Bank Uganda began the year price of 21 shillings and now trading at 32 shillings. That's a gain of over 11 shillings per share. Quite amazing performance, and it's still ranking as number one in terms of highest performing year to date here on the Uganda Stock Exchange. As well as the volumes are concerned, there's a lot of promising performance. When you look at the number of shares that have been traded just within the past quarter, over 75.2 million shares, valued at least 2.4 billion. To put that in context, just look at a billion shillings rather, and then you compare with the price of 30 shillings. That means that's a huge amount of market movement, and that's exactly what we are looking for. We are not just looking for gainers, we're also looking for stocks that can trade, stocks that are liquid, and this is exactly what Stanbic Bank is giving us. But you also talked about MTN. For me, MTN has kind of leveled off. However, after the announcement of their dividend increase this quarter, there has been a number of investors that have got more interested in the stock. However, there's also been a number of probably investors that have become disinterested. I don't know what you would say, Victor, but last year, when MTN was listing, we had a lot of new investors, a bunch of new investors investing with very high expectations. So when you come up with dividends of 7-6 shillings, some of them don't see really the value because of the small number of shares they have. But I would say MTN is still a resilient stock as well.
Well, thank you, Anthony, for those insights. But turning our attention to the stock that came up with the highest traded volume, we're looking at Bank of Baroda that came up with about 264,800 traded shares, followed by Stanbic Bank Uganda with 29,600, DFCU Bank with 24,300, and Uganda Clays with 16,800. But turning our attention to the market indices as well, the benchmark, the all-share, the Uganda Securities Exchange all-share index inched up by 0.73, leaving us at points to close at 908.82. This is about 0.8%, and this is representing a one-week gain of 0.88%, a four-week loss of 2.56%, and an overall year-to-date loss of 25.05%. So, Anthony, what do you think about the all-share index and its recent performance?
Well, the all-share index is indicative of the performance of the stocks that we just mentioned earlier, including Bank of Baroda, like you mentioned, and MTN as well as UCL. I would say what has made the index, the all-share index, move up mainly has been appreciation on the cross-listed counters like KCB and Jubilee Holdings, as well as the Equity Bank Limited stock. The local company index hasn't performed quite well, obviously because of losses from the domestic listings, and the local company index has decreased by 0.14% from the last day of trading, Friday last week. And this is at a 1 week loss of now 0.78%, 4 week losses of 1.43%, but yet a year-to-date gain of 1.98%. Overall, the year-to-date gives us a picture that markets have improved since the year began. However, weekly and monthly performances have indicated a decline. So November hasn't been a good, probably a very good month for the local stocks, and we'll see details there from the Capital Markets Authority as well as the Uganda Securities Exchange. But what I would say, Victor, is that we're heading for Christmas. Probably people are shoveling up that money for Christmas shopping, and very few are actually putting it at risky assets like shares at the moment. That's what I would say is influencing some of this. And whenever we have less demand and more supply, that's when the stocks are going to fall. So around this time, you would expect investors to be saving up money for Christmas, saving up money for family.
As a reasonable investor, would you liquidate your stock to do Christmas shopping?
Personally, I wouldn't. But as what I know about Ugandans, we have so much frenzy and excitement when it comes to Christmas. And one of the things that we really want to celebrate is family during this time. We want to gift, we want to go out. And I would think Ugandans would actually liquidate stocks to be able to finance some of these ventures.
So you're going to liquidate your 750 million?
Yes.
To take your grandma out?
I would think that would be a big
Interesting.
That would be too much probably for shopping and all. But I would still say we're going to see more of this in December, I would predict, because we have seen this in the past. At the close of the year, people are not sure. People are not sure. They just want to know, where is my money safely invested and how can I enter January without worry?
Well, thank you, Anthony, for those insights. But shifting our attention to the digits coming in from the Uganda Securities Exchange Local Company Index. On the other hand, it actually decreased by 0.14% to close at 278.07 points. This is making a 1 week loss of 0.78%, a 4 week loss of 1.43%, and a year-to-date gain of 1.98%. But shifting attention to one of the biggest, the most influential pieces of news to investors in Uganda, especially investors in Cipla quality chemicals. We had some information coming in from the delay of closure of the deal that has been going on for the past few months. So any information coming in from that side?
Yeah, the share purchase in which Africa Capital Works acquired 51.18% of Cipla Quality Chemicals stake in the company. It closed at just about a week ago, and this was after a 6-month delay. This purchase was supposed to be made in April earlier this year, and then they pushed to May, then they pushed to August, and then finally it was done just a few days ago. Now the 6-month delay has cost Cipla Quality Chemical Industries close to 20 billion, according to a disclosure published together with the company's financial results. Cipla and Africa Capital Works had planned to complete the share price purchase of at least 94.5 billion shillings, or close to $25 million US, a deal by 31st of May, but mandatory approvals by the CMA and the Common Market for East and South African countries delayed for months on, and this was just coming in at the end of October. The deal, which will see Cipla dispose of its 51.18% stake in Quality Chemicals, was completed on the 14th of November, and this is according to a notice filed by the Uganda Securities Exchange. However, when you look at the delay, maybe Victor, what could be some of the underlying instincts when you look at what happened with the 20 billion loss? What could be some of the underlying factors?
Well, looking at the situation, the delay definitely impacted contract manufacturing. So, looking at all this, it actually declined by 80% due to uncertainty regarding the closing of the sale. So, even as the company registered significant revenue growth in most customer segments, this actually affected its normal efficiency. But the gains in other customer segments were offset by a significant decline in contract manufacturing, which declined by about 19.9 billion Ugandan shillings, or 80%, owing softening demand from Cipla Limited and uncertainty regarding the timing of the closing of the sale. So the financial statement signed by Mr. AJ Kumar Pal, the Cipla Chief Executive Officer, and Emmanuel Katongole, the Executive Chairman, noted that Cipla, an India-based drug maker, acquired a majority stake in Quality Chemicals in 2015 at a reported $26 million US, which is about 98.3 billion, which had been actually revised from a tranche considering of $30 million US over a 5-year payment schedule. So in this particular case, the drug maker actually it runs different production lines, including antiretrovirals, anti-malarials, among others. And last week, it indicated the shareholding structure of Quality Chemical would actually effectively change after disposing of its 51.18% stake to Mauritius-based equity fund Africa Capital Works.
Well, Africa Capital Works is now Quality Chemicals' largest shareholder with a 51.18%. And this is ahead of Amistad and SCB Mauritius, SC Capital Works SSA, which holds at least a stake of 11.51% and 11.15% respectively. Now, interestingly, the big person behind these companies is the same. When you look at the SCB Mauritius SC Capital Works company, it is still the same leader who owns the African Capital Works Investment Fund. That means that he or she has the biggest stake within Cipla. Other shareholders include government employees, pension fund with an 8.54%, the National Social Security Fund with at least 7.38%, Emmanuel Katongole with 2.79%, as well as Frederick Moteri Chitaka with at least 2.79%, George William Bagumo with at least 2.79% as well, Joseph Yiga with 0.11%, and UOP Insurance Life Fund with 0.07%. This continues to show you that equity markets, private equity markets, are also existent, and you can be part of them. It's not entirely about the shares or the public equity. We do have private equity, like these gentlemen here who have a stake in such a drug manufacturing company. You can also venture into some of these spaces. That is just for our viewers. Now, in the 6 months ended September, Cipla reported an increase in revenue by 1% to 121.2 billion. This increase was largely due to higher drug orders from institutional bodies and sovereign customers, with which at least rose to 5.7 billion tune and 13.9 billion respectively. Private sector also rose by 1.7 billion or 52%, but slow demand due to uncertainty on the transfer of shares actually offset the positive financial indicators.
So Africa Capital Works actually returns to Quality Chemicals, having withdrawn from the business prior to September 2018, when the company floated an initial public offering. So during this period ended September, Cipla reported a 74.3% drop in profits to shillings 3.6 billion from 13.9 billion Ugandan shillings due to a shift in the company's product mix. So Cipla also indicated that it had fully recovered the debt due to Zambia, with the last collection of 9.4 billion Ugandan shillings coming in the period under review. So Cipla had for many years actually provisioned for the debt, whose recovery had taken longer than planned.
Now, Africa Capital Works is an investment company, and there is a plan. What is that plan? When you look at the details submitted to Commerce Competitions Commission, they have a plan to shore up Quality Chemicals' profit position, which remains unstable, especially with the highly competitive pharmaceutical industry in Uganda currently, with so many new pharmaceutical companies cropping up. And we have a rough figure of at least 25 new pharmaceuticals or pharmaceuticals that are existent in Uganda. In its strategic plan, Quality Chemicals will, in the next 5 years, build a new oncology facility and also automate its supply chain and expand its production line with 9 new drugs, including the recently introduced Flozicard, which is a diabetes drug. CIPLA has already indicated that the share sale has been completed. Finally, Victor, this comes to an end, and we want to now see what is ahead for CIPLA on the stock market. What do you think this is going to actually mean for CIPLA investors, especially for our viewers here on the public equity markets?
Well, their plan is certainly supposed to bring their share price down, but as a focused investor, this is supposed to be an opportunity for you to get in before these plans actually take course and start patching up the holes the company is trying to cover up. Not cover up, but seal. And as this happens, the share price is bound to go up and create profits for shareholders. So as many as, because you know investors have types, some of them want to get in and be out by in like 3 months or so. But when the share price goes down, many investors are bound to run because they're not sure if any of these plans are going to go as everyone has envisioned. But this is supposed to be an opportunity for people that have always been waiting to hold a larger stake in an entity like equity, like Quality Chemicals, to get in at a cheaper price and lock in and just hope for the best. So I think this is such a wonderful opportunity for anyone that has been hoping to get stake in CIPLA Quality Chemicals. Once these plans start to get in motion, you shouldn't waste any time. Just run to your nearest stockbroker and get yourself some shares from Quality Chemicals.
Well, I would also agree with you. However, there should be a caution that when a company hits rock bottom, there's nowhere else to go but up. CIPLA last week lost almost 25% of their share price, from 65 on average to 52 Ugandan shillings. Now that should give you a picture of what is going to happen from there. If at all we are seeing CIPLA currently giving these some profit warnings here and there, but still they're explaining these as being due to the fact that they had a debt that was unpaid by Zambia, and now it's being paid, and that's why the profit position was higher last year than it is right now. It's a very, very clear reason, though of course investors won't understand that. Sometimes they will just say, okay, they're losing, right? However, like Victor mentioned, it's a good time to invest in, and Warren Buffett always mentions, when the streets are bloody, it's the time to go out there and actually hunt for stocks. That's how the stock market really, really works. To me, I would think, yes, CIPLA has a very good future. With the new facility that is underway, the oncology project, we are expecting to see a lot more drugs on the market. And also the private market penetration has also been low, but it's one of the strategies that Africa Capital Works thinks they're going to be able to push the company to higher profit positions. And I agree absolutely. The oncology product is going to be one that is going to help the company expand its lines to the manufacture of anti-cancer drugs, and that will be one of the most expensive projects that the company will have to invest in, but also one that could be more profitable. There are many cancer patients in Uganda currently. If you could go to Mulago Cancer Institute, and most of these cannot afford the very expensive medicines that are being imported. So I think if CIPLA comes in to address this issue, and also if the new management really focuses on building a product mix and away from the antiretrovirals and the anti-malarials, this would be a very good competition within the region, but also good return for the investor. We're going to take a quick break, ladies and gentlemen. We'll be returning shortly. We are going to be going to Nairobi and the rest of the world for the latest financial markets news. Anthony and Victor will be right back after this short break.
Smart 24, driving business.
Cooking oil like no other makes your meal so sweet and scrumptious. The taste of Uganda, yeah, the taste of Uganda, the taste.
Ugandans come to Ginger City every weekend, and December 16th, 2023 is Uganda's end-of-year party as Smart FM hosts the Smart Swag Fest Season 2. Don't miss performances from Uganda's top DJs, MCs and artists like the king herself, Cindy Baby, and her full band, Fig for Maker, UG Boys, Kesmon Switch, King Zamba, Waymaker Official, Voice Nancy, Zach Tom Rizla, Lance Soldier, and many more local artists. Let's meet at the chairman's back, next to Ginger Showgrounds. Get your early bird tickets now at 15K and at the gate 20K. Gets open from 10 a.m. till late. The Smart Swag Fest is organized by 89 Smart FM and Hot Shots. Powered by Smart 24 TV, Sisan Suits, NBS Cordeo, GZ Mechatronics, Ginger Hippos, Kampala University, Albeit Electronics and Solar Center, TMU Tubing and Rafting, Banji Uganda, Quad Biking Ginger, Cable Giants, Stardom Visuals and Audio, Bidco, and Club. Tastefully different. Not for sale.
Smart 24, driving business.
Welcome back and thank you for staying with us. This is Smart 24 TV, where we drive your business. You can watch us live on Smart 24 TV live on YouTube, as well as on any of the GOTV or DSTV channels that we do have on those different channels there. As you can see on your screen, you can also catch the show and give us feedback on our Twitter and get to share with your friends some of the links there. That is at Smart 24 TV now. Follow for more, and of course give us feedback through that Twitter handle and the Twitter space. Well, now let's get to cross over to Nairobi, Victor, and have a look at the busiest and the biggest stock exchange in East and Central Africa. What's happening in Nairobi, Victor?
So at the end of the last weekday of trading on the Nairobi Securities Exchange, we're left with a total of 5,884,700 shares in about 834 deals. So this was corresponding to a market value of 107,867,425, and that is in Kenyan shillings. So compared with the previous trading day, the data is actually showing a 9% decline in volume, a 35% decline in turnover, and an 8% decline in the number of deals. So the current market capitalization stands at 1.45 trillion Kenyan shillings.
Well, in aggregate, we have 48 listings out of the 66 participants in trade. Kenya has 66 total number of companies that are listed on the main and growth enterprise market segments. In the Friday trading, at least 48 of these participated in trade, ending the day with 21 gainers and at least 18 losers on the market. Express Kenya led the gainers with a 9.92% appreciation in price, closing off at 3.99 Kenyan shillings per share, We also had Unga Group at least at 9.87%, and Nairobi Business Ventures at 9.79% as well appreciation, and Kaptura Tea Company at 9.46%. Most of these, Victor, are mainly on the growth market segment, and this is where Kenya really gets ahead of us in the game. When you look at what their growth market enterprise is actually comprised of, companies like Express Kenya. This is simply a company that is engaged in provisioning of clearance and forwarding services of air and sea, as well as warehousing and logistics services. And when you look at the investments in this company, over just 190 million Kenyan shillings is what we have, which is about a 0.013% of the entire equity market in Nairobi Securities Exchange. Now, that shows you that these are actually some of the most tradable stocks, or stocks that can be liquidated because they are affordable. They are quite cheap, and even retail investors can be able to participate in the trade. Now, as you can see there, that's a list of some of the gainers, the top gainers, and the list of some of the bottom losers. We're seeing SGL there, that is Standard Group Limited, and this is also a Kenyan company engaged in media, and this is mainly printing media. It is still a small stock with at least just about 613 million Kenyan shillings worth of stock. When you look at that second one there, it is Nairobi Securities Exchange itself. Remember, Nairobi Securities Exchange demutualized and became a company as well on its own, and you can see it there as a top gainer at a 4.73%. You can also have a look, Victor, what we have there down as some of the gainers, including Absa Bank down there at a 1.29%, and then CIC Insurance Company, as well as the Standard Chartered Bank.
But shifting our focus to the bottom losers, we're actually looking at Sanlam Kenya, that came out last with an end-of-day price depreciation of 0.09%. So this is about 6.80 Kenyan shillings per share, and it was followed closely by Home Africa with a price depreciation of 9.09%. We also saw TPS Eastern Africa Serena with 4.17% share price depreciation, and East African Cables with a share price depreciation of 3.3%. And looking at the highest volume, we're seeing KenGen, that we're not seeing in any of the bottom losers or the top gainers, but we're seeing it recorded the highest trading volume of about 1.51 million traded shares. So it was followed by Bamburi Cement with 1.09 million shares, NCBA Group with 916,300, and Kenya Reinsurance Corporation with 868,100.
Wow. Well, also on the bottom losers, Kabasid, which is a liquefied carbon dioxide manufacturer, also declined quite significantly by over 9.9% at a 4.27 billion Kenyan shillings market capitalization. The stock is also amongst the small stocks that are listed there. It is a maker of a fire extinguishers, if so to say, for Kenya, for the local market in Kenya, and regional market as well. Another bottom loser as well on the market included Scan Group and Ever Ready East Africa. Ever Ready East Africa also lost 4%, and Equity Bank at least lost 2.09%, and then Diamond Trust Bank Kenya lost 2.07%, whereas Bamburi Cement as well lost 1.43%. That is still speaking to the bottom losers, but we are going later on to digest the third quarter results of the banking sector, right, Victor?
Yes.
And we're going to be looking at all these banks, including Standard Chartered, Equity Bank, the Diamond Trust Bank, as per the third quarter results. These results were released last week, Victor, and it's very prudent that we give investors a little bit of insight.
But still putting our focus on Nairobi, we're also seeing some recent news about Kenya being ready to actually privatize its state farms. And this was actually highlighted by His Excellency Ruto, or the President of Kenya, and it was during an official function. So Kenya's President William Ruto actually said this Thursday that his government was ready to privatize 35 state companies trapped in government bureaucracy in a bid to boost productivity following a change in laws. So last month, Ruto's government actually signed a revised privatization bill into law that makes it easier to sell state enterprises to privatize companies. So the revised law actually, in this case, is aiming to push up the private sector's participation in the economy, and the presidency actually said at that time that that is exactly what he was aiming at when he was signing this agreement.
Well, the president said that they have identified the first 35 companies that are going to offer the private, that they're going to offer to the private sector. Ruto told one of the Africa stock market officials on last week in Nairobi. He added that the government was also exploring options regarding some 100 state-owned farms, saying that many would be lucrative companies but are trapped in government bureaucracy when services they are offering can be better offered by the private sector. He also mentioned that East Africa, they will be able to make this opportunity available. Now, East Africa's economic powerhouse is facing a host of challenges currently, including depleted government coffers, the skyrocketing inflation, and the plunging currencies that has led to a soaring debt burden or debt repayment cost. The International Monetary Fund said this month that it had agreed to at least $938 million loan to Kenya, which also has a 2 billion euro bond payment due next year.
Well, the IMF also urged Ruto's government to reform public sector firms, and particularly the national electricity supplier. So Kenya Power and the national carrier Kenya Airways actually also suffered record losses in 2022. So the World Bank said on Monday that it expects to provide the country of 53 million people with $12 billion in support over the next 3 years. So Kenya had actually accumulated more than 66 billion $, which is about 10.1 trillion Kenyan shillings in debt by the end of June. So according to the Treasury figures, it is equivalent to around 2/3 of gross domestic product.
Wow, that's a developing story there from Kenya, and we'll be keeping you up to date with what's happening. But still making headlines in Kenya is the fact that Africa borrows war funds to survive. Now, when you look at different African capital markets, there's been a struggle as many seek to woo institutional investors to increase their portfolios held in the private sector equities as foreign investors flee domestic markets. According to the experts who attended the Africa Financial Industry Summit in Lome in Togo last week, institutional investors who have traditionally prioritized investing in government bonds that generally offer higher returns and are much more predictable have a huge potential to invest more in stocks and equities than they currently do.
So increasing their portfolio in equities and stocks could actually serve the needs of the continent's private sector businesses that rely on these markets to raise capital, as foreign investors would have always actually dominated the continent's bourses, flee amid a slump in liquidity globally. But experts are actually saying that investing more in the domestic capital markets also serves the needs of these institutional investors, such as the pension funds and investment banks. So since it helps reduce their risk exposure and maximizes returns, it's actually in this case, but their participation in stocks has actually traditionally stagnated. market?
The narrative has been that the funds are invested in government bonds, and yes, that's about 60% that are invested in government bonds. But in about 5 years ago, it was actually shifting to 80%. That is progress, and that they think the numbers invested outside the bonds will increase. According to Dave Udwana, who is the CEO of Nigeria's Access Pension. Now, African capital markets have lately suffered a massive capital flight by foreign investors. This is a problem, Victor, that we've been actually citing quite a number of times here on the show. And this capital flight has been due to mainly increased risk perception from the currency depreciations and mounting economic shocks. At the Nairobi Securities Exchange, for instance, foreign investors' participation has dropped from 50%, the renowned 50% of all the transactions in July last year, to at least 44% by September this year, as the amount sold by the foreign investors exceeds the amount taken up by others.
So as all this is happening, we're going all the way back to September. Institutional investors actually held only 36% of the equities at the Nairobi Bourse. So retail investors had actually 45%.
Impressive.
And in the bond markets, however, corporates hold over 90%. So
Wow.
while individual investors held only 5%, according to the statistics from Kenya's Capital Markets Authority. But with the flight of foreign investors amidst liquidity slump, both internationally and locally, the Nairobi Bourse and many other across the continent have recorded a decline in activity and share performance and rating. But according to experts, a little more participation by institutional investors could not only actually turn their fortunes, but significantly contribute to the growth of the continent's economies as well.
Generally, Victor, capital markets actually do reflect overall development of the economy in terms of economic activity, in terms of human capital, regulation and policy, and so on. And it's very difficult to expect that the capital market will provide some level of support to the economy in countries such as in the southern part of Africa, as they would in more developed countries of the West, where investors have more capital in general. Now, Mr. Maiga actually told journalists that as the continent works on redefining the inaccurate risk premium attached to the African markets currently, there is need to boost capacity for corporates to finance to raise finance from the capital markets, as they can drive economic development.
So we need to do this by making it easier for corporates to fund themselves. And it's not only for bank loans, but also by going to capital markets, which will happen by changing regulations, reducing costs, and building awareness and capacity so that issuances can go to markets easily and cheaper, and investors can actually invest faster and cheaper. But traditionally, investing in government paper has been easier and cheaper, making institutional investors prefer them, in turn crowding out the private sector investment, according to Mr. Maiga. So structural difficulties to listing and high transaction costs have also hindered private companies from using the capital markets as a source of finance. But as we're seeing all this going on within the financial markets of Nairobi alone, we also want to shift our focus to the market indices and see how they're affecting investor sentiment and the performance of all other listed equities at large. So looking at the all-share index, Anthony, what do you think of what is going on there?
The all-share index moved up at 0.6% and 0.6 points, up to 92.24 points. Clearly, with the one-week gain of 1.92%, the markets could not be any better right now at the Nairobi Securities Exchange. But also, the other indices that performed remarkably well were the NSE 10, the track of the top 10 companies which have the highest market capitalization. This improved by 0.64% as well. The NSE 20 as well improved by 0.31%. and the NSE 25 at least improved by 0.75%. So it's a good picture. I think the markets are healthy, and this is mainly dedicated to the small stocks, I would say. When we were, of course, going through those statistics, you mentioned, Victor, that in Nairobi, the institutional investors have gone up, as well as the retail investors. You saw at least 45% and 30% respectively. Before, the foreign investors were taking up over 50%, and we saw so much activity in the big stocks like Absa, Safaricom, and so on, but very little on the small stocks. Now it's the reverse. Now that we have more retail investors and institutional investors, we're also seeing the smaller stocks as well gain traction and movement on the market. So I think the market is healthy in Nairobi, and we expect the best, at least for the end of the year 2023.
Indeed, but looking at other remarkable indices that are on the Nairobi Stock Exchange, we're looking at the 10-share index that went up by 0.64%. So we're looking at about 1.89% one week profit, and a depreciation of 6.62% in terms of year-to-date. But the 20-share index is showing a 0.31% appreciation and a one-week gain of 2.59%, as well as a year-to-date loss of 9.89%. Looking at the 25-share index, we're seeing an appreciation of 0.75%, a one-week gain of 2.09%, as well as a year-to-date loss of 22.88%. Now, for the major question when it comes to indices like these, we're looking at Uganda having only the all-share and the local company index. What is your take on this? Do you think Uganda can actually take on measures like this to enable financial markets on a local basis thrive in general?
No, I wouldn't say no. Yes, because you have only 18 companies, now 19 companies listed, and you're comparing with the market with over 66 companies. Why do we need more indices? We need more indices to make it easier for investors to actually understand or interpret the market. And so if you have fewer stocks listed, if you have less movement, why then have more indices? What I would say is that the USE should continue with the incentivization campaign of listing new stocks. The moment we have more stocks listed, then we push for more activity as well. We can push them both concurrently, more stocks, more movement. The more we have those, then we can have the more indices. We can have the NSE 10, the USE 10 maybe, for example, and these can actually turn into other products like derivative products, contracts and futures, and so on. But for now, I would say we're doing quite well with the local company index and your share index as well. But Victor, we have quarterly results. We're running out of time, but we'll give our viewers just a little bit of these results for the banking institutions in Kenya. And tomorrow we'll be breaking it down all for them. But looking at the third quarter of 2023, we have quite a number of banks that actually issued their financial statements, including Equity Group, as well as Standard Chartered Bank Kenya, KCB Group, the NCBA Group, I&M Group, Absa Bank Kenya, Stanbic Bank Kenya, all released their third quarter results last week. Some of the general trends we observed from the results included increased cost of funds, as well as increased provisioning, cuts in government securities holdings, and regional subsidiaries outperforming the Kenyan units.
But looking at this report, we're looking at so many highlighted points. We're looking at the loan books versus government securities, which has been a matter of debate for quite a while now. And we're also looking at expensive deposits and concerning asset quality.
Asset rich as well. You can look at some of what KCB has also been able to achieve within the last third quarter.
Indeed, but getting into detail with KCB particularly, after breaching its 1 trillion Kenyan shillings in assets in 2021, KCB Group's asset base was actually up by about 65% year on year to cross the 2 trillion Kenyan shillings mark and reach about 2.1 trillion Kenyan shillings. So this is attributable to about 43% organic growth and 22% owing to the TMB consolidation. So this was the highest growth in assets across the reporting banks, followed by I&M Group, which was up by 26.9%, which is about 544.1 billion Kenyan shillings, and Standard Chartered Kenya that recorded the lowest growth at 1%, which is about 369.7 billion Kenyan shillings.
For the Kenyan banking units, KCB also recorded the highest growth in assets at 49.7%, while Standard Chartered recorded the slowest growth at 1.0%, just like Victor mentioned. KCB Kenya was the market leader at least 1.4 trillion Kenyan shillings in assets, with Equity Bank Limited following at 973 billion, and a gap of 433.7 billion. Now we are going to definitely give you a fuller report as per tomorrow. We have loan books, like he mentioned, versus government securities, as per how these investments have been made by these banking institutions. We do have expensive deposits as well, the increased interest expenses for these banking institutions, and then of course issues concerning asset quality and increased provisioning amongst these and more. So stick around, we'll definitely be bringing you more of these updates tomorrow. Right now we are out of time, but we are definitely grateful and humbled that you have been able to share with us this 1 hour, and we hope we definitely added some bit of value to your morning. Have a very lovely day. My name is Anthony.
My name is Victor Chiberu.
Catch you tomorrow, same time, same place. Bye for now.